Financial ratios are vital tools for accountants, financial analysts, investors, and others interested in evaluating the financial health of a company. These ratios are algebraic expressions that help in understanding the various aspects of a company's performance, stability, and profitability. They provide insights into how well a company is performing financially in comparison to previous periods or to other businesses within the same industry. One key section of financial ratios focuses on liquidity. Liquidity ratios determine a company's ability to meet its short-term obligations. The current ratio is a common liquidity ratio and is calculated by dividing current assets by current liabilities. A higher current ratio indicates a greater ability for the company to pay its liabilities over the next year. Another essential type is solvency ratios, which assess a company's capacity to meet its long-term obligations. An example is the debt-to-equity ratio, which compares a company's total debts to its shareholders' equity. This ratio can reveal how aggressively a business is trying to grow compared to its equity base. A higher ratio might indicate more risk, as it suggests higher debts relative to equity. Profitability ratios are used to evaluate a company's ability to produce earnings relative to sales, assets, and equity. The net profit margin, calculated as net income divided by sales, provides insight into how much profit a company generates from its revenues. A high net profit margin indicates efficient cost management and profitable operations. Efficiency ratios measure how effectively a company uses its assets and liabilities internally. The inventory turnover ratio, which is calculated by dividing the cost of goods sold by average inventory, is a primary efficiency metric. A higher ratio indicates effective inventory management and robust sales performance. Lastly, market valuation ratios give insights into the market's perception of the company. The price-to-earnings, PE ratio, for example, is a classic market valuation metric. By dividing the current share price by earnings per share, investors can better understand how much they are willing to pay for $1 of earnings, which relates to growth expectations and investor confidence. In conclusion, understanding financial ratios and their implications allows stakeholders to make informed decisions about a company's financial strategies and direction. By exploring liquidity, solvency, profitability, efficiency, and market valuation, one can derive nuanced insights into a company's operations and potential for future success.